Right, guys, just a quick video on a Kiwi yen long trade idea, swing trading opportunity. Now, looking at the Kiwi yen, our fundamental bias for the currency pair, our outlook for the pair, for the Kiwi yen, remains bullish, remains tilted to the upside based on a fundamental bullish outlook for the Kiwi dollar, as well as a fundamental bearish outlook for the Japanese yen. Now, let's quickly start with the Japanese yen. The yen has been pressured by two main drivers over the past couple of months. The first one was the underlying positive outlook for risk assets after the record amount of both fiscal as well as monetary policy support thrown at the global economy after the COVID-19 crash. So the first one was risk sentiment. The other one, apart from that, was the Japanese yen that shares a very sharp inverse correlation to any type of price action moves in the US 10-year yields. Now, like most correlations, the strength and the influence of US 10-year yields on the Japanese yen will change from time to time. But as the current upside in US 10-year yields are upside expectations driven by upside expectations in growth and inflation and, of course, policy, the inverse correlation between the Japanese yen and US 10-year yields has been especially strong this year. And a very good example of that is the very strong positive correlation that we can clearly see here between the dollar-yen currency pair as well as US 10-year yields. Now, apart from that, the recent big pop to the upside that we've had in oil prices over the last couple of weeks is a little bit of a double whammy for the Japanese yen because firstly, higher oil prices can translate into upside surprises for inflation expectations. When that rises, it places upside pressure in US 10-year yield. So once again, a negative impact for the Japanese yen. And also considering the fact that Japan is a very big importer of oil, this rise in oil prices is definitely having a negative impact in Japan's terms of trade. So it's a little bit of a double whammy on the Japanese yen. So based on the fact that apart from all of that, the Bank of Japan is still considered as one of the most dovish among the majors. They're sitting on negative interest rates, and there's no chance, at least in the foreseeable future, for them to move away from that anytime soon. And that means that based on that, as well as the other factors we mentioned, our fundamental outlook for the Japanese yen remains bullish. Now, when we turn our attention then to the Kiwi dollar, for the Kiwi dollar, our bullish bias, was first driven over the last couple of months, was first driven by the Kiwi dollar's pro-cyclical characteristics. We saw commodities as well as commodity-dependent currencies like the Kiwi dollar being lifted by that overall recovery and expected recovery in the global economy. We had a large reflationary environment with huge upside surprises playing out for both growth and inflation. That was the driver really from the middle of 2020 up until the start of the year. From the start of 2021, though, the Kiwi has been more driven by monetary policy. The RBNZ was one of the first major central banks to start stepping away from that ultra dovish policy language in the early stages of the year. And that has turned more and more hawkish as the year progressed. In July, we actually saw the bank being the first major central bank to completely scrap its QE program, stop quantitative easing, and start that normalization process. Now, if we quickly go to the August monetary policy report, the bank in August projected up to 7 rate hikes between the fourth quarter of this year as well as the first half of 2023. Now, if we consider that expectations for other hawkish central banks like the Bank of Canada, like the Bank of England, is only expecting 1 hike in 2021, the RBNZ right now is miles ahead of any of the other major central banks when it comes to tightening policy. Also consider, if we take a look at where interest rates are tracking across the global central banks right now, if the RBNZ, they've already hiked rates today, bringing their rate from 0.25% to 0.5%. So they've already put in 1 hike. That already puts them double the second highest, which is now the Bank of Canada at 0.25%. So if they get just halfway to where they're expecting to go in terms of their rate path projection, that'll place them just head and shoulders above the rest in terms of interest rates. Now, the reason why that is important for us is because it opens up a lot of upside potential for the currency in the months ahead, because it will have the most attractive carry of any other major economy and should support the currency in the months ahead. So based on all of that factors, based on that clear monetary policy divergence, our bias for the Kiwi dollar remains bullish. Now, if we quickly turn our attention back to the Kiwi yen, recently, due to many different negative factors, underlying risk sentiment has taken a beating. And that alongside, some repricing in Kiwi rates from the recent COVID outbreak we had in New Zealand, we have seen Kiwi yen trading lower towards some very key and attractive areas of technical support around that 77 and 76 psychological levels. Now, with our medium-term bias still intact and tilted to the upside, we would like to add add long exposure to the Kiwi yen in the weeks ahead. Anything between 77 and 76, we think, is a possible opportunity area to look to add some longs. Looking to anchor stops just below that most recent significant swing point, coming in close towards that 74.30. Then we'll be looking to target a first possible area back towards that 78 recent highs that we've had. Then we're looking for a second target close towards that 79 psychological level, and then looking for a third target moving closer towards that 80 psychological level. Now, the biggest risk factors for this trade, against this trade, will be any major type of risk sentiment sell-offs we get in the equity markets. That can be potentially driven by further fears of inflation staying a little bit more sticky. We have recently seen some downside pricing coming into equities based on a few different factors. Inflation has been one of the key concerns, though. If we see that translate into bigger moves to the downside in equity markets, of course, that'll negatively affect something like the Kiwi yen, because it is a risk-sensitive currency pair with a high beta, of course, the Kiwi and the safe haven Japanese yen. So if we do see any major flushes lower in risk sentiment, that is, of course, expected to weigh on the Kiwi yen, and that could, of course, be a key risk factor for this pair in the medium term. Apart from that, though, is still the virus situation. Even though we've seen a huge increase in vaccinations, and even though case numbers for now is under control, if we see another major shock to the economy from a huge breakout in the virus once again, and if that starts to really negatively impact growth, and that causes the RBNZ to pause on their planned tightening plans, that will, of course, create a lot of repricing that needs to take place. If we just look at the massive divergence in something like Kiwi two-year bond yields, we can just see the massive divergence between that and any of the other major central banks. So if we see a huge breakout in the virus, there's a lot of room to the downside that can be repriced, and that is a real big threat for the Kiwi in the medium term. Apart from that, though, the bias remains tilted to the upside, and we are looking for some possible long exposures in the Kiwi yen between that 77 and 76 psychological level.